Are you all well? No. Yes. Right. Something I picked up yesterday, which I quickly want you guys to fix before we continue. My apologies for that. It was a small oversight. This is what we've done yesterday. With regards to question 1.2, the Eastern Cape paper with the income statement. Right, yesterday we spoke about asset disposal. What is step number 1 in asset disposal? Take out the cost, where to? Asset disposal. Correct. Step number 2.
Update depreciation.
Update the depreciation. Step number 3. Take out the total accumulated depreciation, where to? Okay. Step number 4. Step number 5. Calculate the profit or the loss on the sale of the asset. Right. So now, if you look at that question, the asset disposal account, and I've rewritten it there as well. This is what we've done yesterday. So we've calculated on the old plus the new plus on that which we sold. What did the sales clerk not do in this question? If you look at the asset disposal account there, he didn't update the depreciation. So if he didn't update the depreciation, isn't the profit on sale wrong? Okay, so that was the slight oversight which I didn't put in yesterday. So I will explain it here. If you have a look, we calculated on the old, the new, and that's what we sold. This is the asset disposal account. So we had a profit on sale of asset. I'm not going to get everything in. And that profit was equal to 100. But that 1,200 was the accumulated depreciation in the beginning of the accounting period. They haven't updated the accumulated depreciation yet. So it means that 60 Rand should have been added. So what is the total accumulated depreciation on equipment? So wouldn't that change your profit on sale of asset? Yes. So take the credit side minus the debit side. What is your answer now? So in total, what are you saying? 2340. I didn't get the same. Did you take 1,260 plus 2,500? Oh. Minus 3,600. What is your profit? Okay, so you actually just needed to add 60. So it means in your income statement, the profit on sale of assets should be 100 plus 60. And that equals 160. Yes, so basically your answer would be, if everything is 100% correct, your answer would be out with 60 Rand. Does it make sense? Okay. I will tell you now. Let's mark the income statement before we move on. There you go. We didn't have a chance to mark it yesterday. The depreciation was done 100% correct. Yeah, of course that will now be out, but that was my mistake. Anybody who had any problem with the income statement? You won't. Oh, you haven't totaled yet, so it works out well for you. Were you fine? Let me see. Oh, you haven't totaled it either. Not yet. Please take note how marks are allocated as well. This is why it is so important. Show your calculations in brackets. Can I move it up? Not yet. Yes.
Also the provision for bad debts adjustments and calculation.
Look, you did the T account. If your T account is on here, it's not necessary. As long as there are calculations on the answer booklet that I can refer back to, yes. Right, are you all sorted? Can I move it up? A little bit? Just say stop. Fine. Okay. Right, if you haven't totaled it yet, close your brackets. Don't copy it down now, otherwise we're going to wait too long. Yes.
If we didn't notice that mistake about, if I didn't see it in the test and I didn't correct it, would I get a method mark for my answer at the bottom?
Yes, yeah, as long as your steps, as long as you've done it correctly.
Okay.
But can you see, this is an easy mistake to make. That's 60 Rand to forget, but I need to change the profit on the sale of asset because they haven't done step number 2. They haven't updated the depreciation. Right. Can we move on? Right, yesterday we were busy with the Eastern Cape 2015, the balance sheet. We finished the current account note by comparing that to the current account, ledger account. Any questions that anybody still have with regards to the current account? 100% sure. Right, next question. Adjustments. Have all of you completed the formats for the balance sheet? Yes, and you have the calculations in brackets, not calculations, the amounts in brackets? Okay, good. Let's continue. Right, if we look at point number E, the following adjustments were taken into account in determining the net profit amount of 462,000. So this is how they got to 462,000. Unused consumable stores amounted to 3,290. So whatever we haven't used, where do we take it? We have to take it to consumables on hand, which forms part of. So go to inventories plus 3,290. Good. Next one. You got it. Next one. The business makes allowance for a provision for bad debts equal to 5% of the debtors control balance. So now go to trade and other receivables. They have given to you the debtors control amount, 127,300. So all I need to do is work out 5% on that, and that will be shown in brackets as my provision for bad debts. So 5% of 127,300. So trade debtors minus provision for bad debts equals net trade debtors. And that gives you a total of 120,935. So here, we don't care about provision for bad debts adjustment. There was nothing to adjust. All we needed to work out what was the provision for bad debts. Are you with me? You don't do it there because I've given you the notes. So you do it in the notes. You don't do it on the face of the balance sheet. They've provided you with trade and other receivables, and they've provided you with trade and other payables. You first have to complete the notes. It is on page 14. Good. Next. If I'm going too fast at any stage, just say yes. Given.
No, the 120.
Oh, it is 127,300 minus 6,365. Because we always subtract provision for bad debts. That's why it is a negative asset. Right, next adjustment. An insurance policy for 4,260 was entered into on the 1st of May 2014. The annual premium was paid in full. Insurance is one that you would always get as an adjustment. So here, same adjustment as in the first question, just given in a different way. How? They said to us, the insurance policy was taken out on the 1st of May 2014. My accounting period ends 28 February 2015. So if we've paid for this insurance policy for 12 months, it means that anything that falls outside of the accounting period must be taken out. So let's think about where would we take it to. If I have insurance, which is an expense, our expense will decrease. Which account will be debited? Prepaid expense. And what is prepaid expense classified as? It's an asset. So which note does that form part of? Trade and other receivables. It's an asset. So how much needs to be taken out? So you can either look at it in two ways. One, what should be included, and then just take 12 minus that, and that should be taken out. Or just count from February up to when will 12 months later be? So how many months must be taken out? Taken out. 10 should be included. It means 2 should be taken out. So you've counted now from May up to February. That is 10 months. So it means 2 months falls outside of our counting period. So this insurance policy was 4,260 times 2 out of 12 months must be taken out. And that will be your prepaid expense, which is equal to 710. Okay. Yeah, I said you have to take it out, but where do we put it in? Okay, look here. So in other words, insurance, I would have had 710 on the credit side. Prepaid expense is debited with 710. So this would have shown in the income statement, which they haven't asked us. They've asked us to complete the balance sheet only. So 710 must be as your prepaid expense. Right, next one. That's why I chose these two questions, so that you can see I can provide you with adjustments and ask you to complete an income statement. Or I can provide you with adjustments and ask you just to complete the balance sheet. Okay. Right, next one. The telephone account for February 2015, 1,840, was only settled in March. So again, if I look at my accounting period, it ends 28 February 2015. This was only settled in March on the 5th, 2015. Again, that falls outside of our accounting period. So if it falls outside, what do we need to do?
You take it out.
So, but now, it shouldn't be included. This is now what you need to realize is, if I'm only paying it later, isn't it then still outstanding for February?
Yes.
Yes. So where should I show it? As
accrued expense.
there you go. I can't hear. Yes, the full amount. They said 1,840. Right, next. The rent for March 2015 was received and deposited. The rent amount of 69,600 was closed off to the profit and loss account. So what makes this one slightly more challenging? It's okay, so how do I get the monthly rent? Because what is clear is that the rent for March was received and deposited. So that is outside of our accounting period again. So normally I would take the amount from the pre-adjustment trial balance and I would divide it by 13 to get the monthly rent. Yes or no? Yes. Okay, but what makes this one different? So what they've done is they've already got the rent income. They've already got the amount which was closed off to the profit and loss account. We need to show all our income and expenses for how many months? So isn't that equal to 12 months? So just divide it by 12 to get the monthly rent. So it's not actually difficult, but there is a small trick on this one that you need to realize. We used to just say divided by 13 because we received it for 13 months. But now they said this was the amount which was closed off to the profit and loss account. So that will equal 12 months. They've already taken out the 1 month. The total brought forward was equal to 13 months. So they've done that, and that's the end amount that appears in our income statement. So now I'm asking you, what was that 1 month equal to? So you just divided it by 12 to get the monthly amount.
So now all the amounts in the final account have been done at the end, and it has to have taken up all the things that have
No. Remember, what appears in the profit and loss account?
all the income and expenses.
For how many months?
For 12 months.
So if they specifically say
It's been closed off.
it's been closed off to, it means they've done that.
Okay, so we can take that they have done.
Yeah.
Okay.
There's no other way. Okay, so now's the question. We had to take it out. So if rent income was debited, which account was credited? Which will be a liability? Or another word for that? So which note? Good, so go put it in. Right, next one. A commission fee of 3,225 was still receivable on 28 February. If it's still receivable, it means we have to include it. Commission would be what? An income or no expense?
Income.
So where do we take this?
Accrued income.
And which note does that form part of? Correct. Which note? Good. So put it in. So we have to take it as accrued income, which forms part of trade and other receivables. Right, now we're going to go to the note. I'm going to open T accounts. You can draw T accounts as well to make sure you understand how to complete it. Right, depreciation on vehicles at 20% per annum on carrying value and on equipment at 15% on cost. A new vehicle costing $145,000 was purchased on the 1st of June. So I'm going to focus now on vehicles specifically. So what I do is when I have an adjustment and they provide me with a new vehicle was purchased or a vehicle was sold, it doesn't matter. When I look at the vehicle account, always start with the movement. If I bought a new vehicle, what will happen to my vehicles? With 145,000. So it means that the list of balances given to you on 28 February says vehicles 700,000. Is that the balance at the end or is that the balance in the beginning? It's the balance at the end. They didn't say that 145,000 was not yet recorded. It said it was purchased on the 1st of June. We need to know when we've purchased it because we need to calculate depreciation on the old plus the new plus that which we sold. So it means in your tangible asset note, I need to work out the cost in the beginning. So how do we get the cost in the beginning? The cost at the end is 700,000. So the cost in the beginning would be? I have to subtract. And if you're not sure, balance brought down means balance carried down. So the credit minus the debit side equals 555,000. And if I bought a new vehicle, it means the cost in the beginning should have been less. Right. Accumulated depreciation on vehicles is a negative asset. So they said to us the balance in the beginning is 280,000. So now what do we need to do? We need to calculate depreciation on the old plus the new. But how do we calculate depreciation on vehicles? So what does carrying value mean? Book value. Okay, so we need to use the book value. So now you can just actually take 555,000 on your note, because you are completing your note. Cost minus accumulate equals book value. And for how many months do we always calculate the old? Good. So what's your depreciation? Good. But I'm going to show it in brackets first, 55,000. Why? We still need to add the new. So to calculate on the new, does diminishing balance method matter? No. Why?
Is that the old one?
Yeah, that's the old.
Okay.
Did you get the same answer?
Yes, ma'am.
Good. Does it matter?
No,
Why?
because we don't have an accumulated.
Why?
Because it's a new vehicle.
Because it's the first time we're calculating it. Right. So it means that I need to take 145,000 times, what is the percentage? But times how many months? When do we start counting? From the day we purchased it until the end of the counting period. When did we purchase it? In June. So it's June, July, August, September, October, November, December, January, February. How many months? 9. Yes. Yes. So what is your depreciation on the new, which was for 9 months? So the total depreciation, fill it in your note. The total depreciation should be 76,750. So how do we get the accumulated depreciation at the end? Just take beginning plus depreciation. There were no asset disposal, so that will equal the balance carried down, means balance brought down. So what's your balance at the end? That's correct. If you didn't get this, please say that I can come and help.
Why do we need that balance?
In the note. Aren't you completing the note? Yeah. Your formats. Cost minus accumulate. So the total depreciation must go in there. Additions at cost. You are busy completing your note. I'm showing you the T account, how to do workings. Are you with me? Additions. So fill in what was the additions at cost. 145. So that shouldn't go next to movement. It should go to additions.
Ma'am, should I move this asset disposal?
Where's your additions? See, that cost is wrong. It should be additions. So put in additions. And now, disposal at carrying value. And then depreciation. So what was your total depreciation for the year on vehicles? 76,750. In brackets because it's subtracted. So how do we get accumulate and cost at the end? Cost at the end was given. It is 700,000. No, that's fine. Accumulated depreciation at the end. And you had to have cost in the beginning as well. So how did we get the cost in the beginning? 700,000 minus equals. Are you all fine with the note, with vehicles? Right. Now, cost minus accumulate equals book value. Okay, so you can work it out now. And then, how do we get accumulate at the end? Beginning plus depreciation. Right. How do we get movement? Take everything in the movement, so it means it is 145,000 minus 76,750. That equals your movement. Right. Now, if you take your carrying value in the beginning, plus or minus, it depends if your movement has a bracket or no bracket, it should equal the carrying value at the end. So it's book value, beginning, plus or minus movement equals the book value at the end. If you take the cost minus accumulated depreciation at the end, what should that also equal to? The book value at the end. This is a way in which you know if you've done it correctly or not. Right. Next one. We are going to look at equipment.
Do you know when your movements are minus number or
when the depreciation is more than the movement, more than the additions.
Oh.
If it comes down to a negative amount. Okay. Right, next one. Depreciation on equipment is calculated 15% on cost. But now, if you go to the last bullet, it says a profit of 320 on sale of an old office desk was sold on the 31st of December. The cost of the desk was 5,400 and it was sold for 1,750. So it's clear that we've disposed of one of our assets. But now, what is missing there?
Depreciation. The cost of book value.
Okay, we need the book value, but what is missing there? Okay, what is the quickest way to find out? Is by putting the information on your asset disposal account. This is why I said in the beginning it is so important to know your steps. Asset disposal, step number 1. Take out the cost, where to? Where would the cost always appear? So they've provided us with the cost. They said the cost was 5,400. Step number 2, update your depreciation. And then step number 3, take out the total accumulated depreciation where to? Okay. Now, do I have that information? Step number 4. So what is the selling price? And where would the selling price always appear? So it was sold for cash. So I have 1,750. And then they said we made a profit. Where would a profit always appear? So I made a profit of 320. So can I calculate the total accumulated depreciation? Yes. What was that equal to? So now what appears in your tangible asset note is the book value, cost minus accumulate equals book value, and that equals no. It doesn't matter the depreciation, calculating the depreciation now. I want what? I want to know the book value. So they've given me all the information needed to work out the total accumulated depreciation. So 5,400 minus 3,970, what is the book value equal to? And this is the amount that comes in your tangible asset note. We do have to work out the depreciation still because we need to show the depreciation on the old, the new, plus that which we sold. So this brings me to the following. For every debit, so the list of balances given to me, equipment, that balance, would it be the balance at the end or the beginning? At the end. So we have a balance at the end of 430,000. Balance brought down means balance carried down. So can I calculate the balance in the beginning? Yes. How do we calculate the balance in the beginning? The end plus. So you add everything on the credit side. So if you battle to do it directly on a T on your note, nothing prevents you from doing T accounts, especially with this one where there's some backwards calculations. So what is the balance in the beginning? Right, now they've provided us with accumulated depreciation in the beginning. We have a balance of 193,500. So we need to calculate depreciation on the old plus the new plus that which we've sold. So there aren't any additions. They didn't say that we bought any additional equipment. So we need to calculate on that which we've sold and the old using cost. So it means all that information I can get out of here. So what is the cost of the old? No. Why? No, that's, I've asked that in purpose, and thank you for calling it out incorrectly. Why? This includes the 5,400. And did I have that asset for 12 months? No, because I sold it during the year. And I sold it when exactly? On the 31st of December. So it means calculating depreciation on that which I've sold must be calculated. How many months is left? It's the quickest way to get to the answer. How many months is left? So how many months do I need to calculate depreciation for? 10. Because we calculate from the beginning of the accounting period until the day that we have sold it. So it means if there's 2 months left in the year, I have to calculate it for 10 months. Calculating depreciation on the old is always for 12 months. So this is why you can actually just take the balance at the end, the 430,000, because 435,400 minus 5,400 equals that which you had since the beginning, which is 430,000. So 430,000 times the percentage is 15% times 12 over 12 equals 1. You don't have to type that in. So what is the depreciation on the old? And now what do we still need to add? Okay, so for how many months? So because we're using cost, 5,400 times percentage is 15% times 10 over 12. What is the depreciation on that which I've sold? Sorry? 675. So the total depreciation for this year equals right, now comes the question, how do I calculate the cumulated depreciation at the end? So again, for every credit, so I would have had here asset disposal. This includes step number 2 plus step number 3. It's the updated depreciation. So how do we calculate the balance at the end? Using your note will work exactly the same as what I'm explaining from here. Beginning plus the total depreciation minus the accumulated depreciation on the asset which you sold. This is why when you write the book value in your note, is it important to show your calculations? Yes. If you've done a T account next to your note, it doesn't matter, then it's 100% fine. Because I can clearly see you got your calculations from there. So again, beginning plus depreciation minus the accumulated depreciation on the asset which I'm selling equals the balance at the end, and that equaled I got the same. Right, now from this tangible asset note, what do I take to the face of the balance sheet? The total carrying value at the end of the year for both vehicles and equipment. Write both calculations on the face of the balance sheet. Did you see where you made a mistake?
Yes, I read out the wrong answer.
Oh. Anybody who needs assistance with the note? Yes, coming. Thank you. You also need help. Yes.
No, I got lost. I don't know where you lost me.
Okay. So in other words, we needed to work out the cost in the beginning. So how do you get the cost in the beginning? It's the cost at the end. So fill in 430,000. Okay, and write there in brackets your calculation. How did you get 1430? And it must be in brackets. You took the asset disposal, 5,400 minus 3,970. Okay, so how do we get the accumulated depreciation? Because you've got that, good. So to get accumulated depreciation, it's the beginning. So now you still need to fill in your depreciation. Where's your depreciation? Oh yeah. So fill in, what is your total depreciation for the year? It's at 65,175. And it must be in brackets. Okay, so now beginning plus minus the cost, the accumulated depreciation on the asset which you sold equals the end. Pleasure. Just a reminder, all accumulated depreciation and depreciation must be shown in brackets. If you dispose of an asset, it must be shown in brackets. If you don't show the bracket, you lose the mark, even if your amount is correct. Yes?
Is the carrying value 175,295?
Yes, 175,295. Good. How do we get the carrying value at the end?
Carrying value at 1st of March plus movements.
Correct, or costs minus accumulated depreciation. So work out. There you can have a look. To make sure you take the correct totals to the face of the balance sheet. Can I take this off while you're marking there? Anybody still busy checking here? Okay. Yes, and then add everything. Once you've taken the carrying value of both to the face of the balance sheet, you can add everything. They've already shown you the land and buildings in brackets. So make sure you take everything that equals the total assets. Right. Anybody still busy? It's fine. Need assistance?
I did this one already.
Okay, what have you done?
Where's this one? I subtracted it from this amount.
Correct?
And I added it to cash and cash.
Yes, correct.
Okay, there I start. Now, just capitalize one. It says it's capitalized. A fixed monthly installment of 8,600 inclusive of interest was paid from the time the loan was received. So, can you take this and then subtract it from the loan?
Yeah.
I mean, that's fine.
Yeah. Because they didn't only say the capital portion of the loan. So you have to take what they've given to you.
And then you just subtract this from the loan.
Mm.
And then current portion of loan becomes
You can put it under trade and other payables or under current
okay.
liabilities on the face of the balance sheet. Yes. Yeah, but I'm gonna continue. Okay. Right, can I take this off? Sure. Next one. 25,000 of the fixed deposit amount will mature on 30 July 2016. Is that outside of our accounting period? Yes. So why would they tell me this? What do I need to do? Good. It's what I explained yesterday. My fixed deposit has a list, in the list of balances, my fixed deposit is equal to 85,000. So now what is happening? 25,000 of that will mature within the next 12 months. So it means we need to take it out, and where do we take it to? To note 6, which is your cash and cash equivalents. So it should be minus 25,000 in brackets, which you've already written. And then that 25,000 must be added to cash and cash equivalents. And then on your balance sheet, what will be your non-current assets for fixed deposit? 85,000 minus 25,000 equals 60,000. And this will form part of non-current. Right. The last one, interest on loan, is capitalized. So it's added to the loan account. A fixed monthly installment of 8,600 inclusive of interest was paid for the time the loan was received. This installment is expected to remain constant for the next financial year. So they've told you exactly what is the installment per month. It is fixed. It's not going to change. So we know that over the next 12 months, we are going to pay 8,600 per month. So we need to times it by 12. And why am I doing this? On the list of balances, which is on your face of your balance sheet, you've got loan, 320,000. Of this, 8,600 times 12, which is equal to 103,200, will be paid over the next 12 months, which means we need to take it where? To current portion of loan. And that forms part of what? Current liabilities. So that means the difference will still form part of your non-current liabilities. So what is 320,000 minus 103,200? Right, now have we covered all the adjustments? So before you finish off the face of the balance sheet, first go and total for me your notes, and then we're going to mark it first before you complete the rest. No, they didn't say. Yeah, but they didn't say we must add interest or anything. They didn't say anything about the interest. They only said the fixed amount payable back.
So if you say capital, if it's not capitalized, then
they didn't ask us to work out any of the interest. They just mentioned specifically, they said the fixed installment, the next 12 months, this is the amount that will be paid back. Okay.
For the phase here, for the current account, you take the total of the retained income at the end of the year.
Yes, it's the end. So in other words,
This balance here.
yeah.
This is not the balance.
Can we mark? You've done marking the current account? Yes, no? Fixed tangible assets you've done? There's debtors, it will come up in 1 minute. They never said anything about interest has not been taken into account yet. So that's why you don't add it. Okay. The focus here was only on the current portion of loan and the fixed deposit that matured. Okay. Any problems with trade and other receivables? Right, you can see all of it were accuracy marks. The balance did it. Good. Well done. Right, can I move it down? A little bit. You can say stop. Right, after you've marked, complete the face of the balance sheet. Let's see whose balance. It should balance now because we've done all the adjustments. It just depends if you're adding and subtracting correctly. Say again.
Shouldn't the current portion be?
Current portion of loan, listen quickly, can either form part of trade and other payables or it can be on the face of the balance sheet. So if you've put it as part of trade and other payables, your answer would be 85,000 plus 103,200. Not if you put it part of current liabilities, not if you put it part as note number 9. Because otherwise you're putting it in twice. So it's either or. Well done. Didn't yours? Good. Right, now tell me in an exam, if it doesn't balance, what do? You move on, okay? Don't go and look for your answer because you could have made it anywhere. And then you're actually just wasting time and you end up not getting finished with a paper or you're rushing through other questions and making silly mistakes. I would actually say don't balance it until you've done with the paper. Then you've put those 2 final amounts in.
No, but if they don't balance, you make them both the same amount even though they're wrong.
You might get a method mark because it's balancing. It depends on how marks are allocated. If I don't allocate marks to showing those 2 figures, then it's pointless.
In one of the adjustments, we have trading stock on hand and we have to calculate trading stock deficit. Do we take it out?
If they say physically we've counted an X amount, that will always be your final amount. So you don't care about the deficit or surplus. That will always be your final amount. The one in the adjustment, that which you physically counted. Unless they say after the physical stock count, there was another adjustment. Then we need to adjust that total. Okay. Yes? Who's called? Oh, am I hearing things? Right. Can we move on from balance sheet? Any questions? Oh, market, you want it? Did it balance? Not. Okay, I'll come now. Right, how do you approach financial statements in an exam? What did we discuss yesterday? Okay, what are you going to start with? What are you going to do? Complete the formats first. Write everything from the pre-adjustment trial balance in brackets or list of balances in brackets. Then you go to the adjustment and you add or subtract. Okay. After you've worked your way through the adjustments, then you close all the balances and you do the final calculations. Right. Any questions there? What happened?
I added wrong.
Oh.
I added extra. Yeah.
Okay. Right. I'm moving it down. Anybody still marking? Please make sure that where you've written the amount next to loan, 216,800, that it's actually the same as non-current liabilities. It does happen that sometimes we find two different amounts, which I've got no idea where it comes from. Please make sure those two should always be the same. Add the current liabilities with.
Yeah, like because we have total assets in like on top to right, like in the top part of this.
I understand what you're saying, but logically it doesn't make sense at all because it says they're non-current. So, but I hear what you're saying. Okay, moving on. Next topic, analysis and interpretation. Right, so we have an accounting cycle which we follow. Does any one of you know what that accounting cycle is? I know one or two that should know. The accounting cycle. What is the accounting cycle? We just did it with that.
Oh, they're saying transactions.
Yes, from a transaction, we complete what? As proof that a transaction occurred. And then next step, which is, what's the purpose? A journal shows the daily transactions that occurred during the month. Right, next step. Okay, what is the purpose of a ledger? Summarize all the journals. Next step. Trial balance. Okay, but now from grade 10, and you'll see later we're going to do a question like that as well. We have pre-adjustment, post-adjustment trial balance. And then we have post-closing trial balance. And there's a difference. A post-closing trial balance means after the closing transfers, after the adjustments happen. So that makes a difference. If they provide you with a post-closing trial balance, it means I just need to fill in where I need to take the information in the financial statements because they've already done the adjustments. Okay, so you need to understand the difference. After we've done that whole process, we complete the income statement, which we've just done, and then the balance sheet, which we've just done. The next step in the accounting cycle is analysis and interpretation. So we need to interpret the financial statements because our owner would have questions. We look at what is the profitability of the business? What is our liquidity position? Are we solvent? What was my return on my investment? So those are the different things that we look at. And we get all of that information by looking at either the income statement or the balance sheet. So it is very important, first of all, that you understand what is each one of that questions, what is the answer to it. If we look at profitability, what do we look at? How effectively did we manage our expenses? We look at how does the cost of financing the business, how did it affect our profits? We look at what was our aimed profit markup and what have we actually achieved. So those are all some of the financial indicators which we use when we look at the profitability. And where do we get all of that information from? From the income statement. That's my reference. That's my source that I need to use if we want to answer that question. Right. Secondly, how liquid are we? Are we liquid? What does that mean? What do we look at? No, not long term. We look at short term. So are we able to meet our short term obligations? So if I'm talking about short term, I'm referring to, and you can use your face of your balance sheet as reference, I'm referring to the current assets, current liabilities. And that's why it's so important to understand your format. Because what does the current assets consist out of? Note number 4, 5, and 6, which is what? Inventory. And? Good. What does current liabilities consist out of?
Trade and payables, current portion of loan,
bank overdraft. That's important to know because they can provide you with a face of the balance sheet, which is easy, or they can give you a list of account names, and then you need to know. But what forms part of current assets, what forms part of current liabilities? So this is again why I'm going to say it is so important to study your formats, especially when it comes to analysis and interpretation, using financial indicators, doing calculations. Right. Now, when we look at liquidity, there are 6 financial indicators which is a must for you to know. Does anyone know what those 6 are?
Solvency, asset ratio.
Not solvency. Right. We have because I can ask you comment on the liquidity. So then you need to know which financial indicators to use. And there are actually 6 of them. Right. So we have the current asset ratio, the asset test ratio, and then we have debtors, collection, yes, creditors, payment, and stock holding, and stock turnover. Now, there's actually a reason why I've put them in this order. These 2 are BFFs. These 2 are BFFs. And these 2 are. But these 2 could also be friends with them. Okay. When we comment by comparing last year with this year. That's one way of commenting. To look at, was there an improvement, yes or no? Secondly, we can look at those specific BFFs. Why? If I look at current asset ratio and the asset test ratio, I look at let's rather say, does my current assets exceed my current liabilities? Will I be able to meet my short-term obligation? But the asset test ratio tells me if I take inventory out of the equation, will I still be able to meet my short-term obligation? That will give us an indication, is too much money tied up in trading stock, yes or no? And what is the risk that I'm taking if too much money is tied up in my trading stock? Okay, so these are all questions that need to be answered. So if, example, ratio is always 2:1, so if my current ratio is 1,5 to 1, what does that mean? Good, for every R1 of current liabilities for debt, I've got R1.50 to pay. That's 100% correct. Keep it simple. What does that mean as well? Just? That's not simple. But it's a good answer. What does that mean? Your current assets exceed your current liabilities, we will be able to meet our short-term obligation. That's it. But now I say to you, right, taking inventory out of the equation, it dropped to 1,1 to 1. Now what does that mean? We're still liquid. We would still be able to meet our short-term obligations, even if we don't sell our trading stock. So all on the same page, all you need to say. But now we change that to, so are we in trouble? Yes. Why are we in trouble? But we are still liquid. Doesn't our current assets still exceed our current liabilities?
Yes,
See, that's how you answer it. We are still liquid. We will be able to meet our short-term obligations, but we take the risk if we don't sell our trading stock that we will not cover our short-term obligations. So we're not in trouble. It doesn't mean once this one becomes less, if that is less, this is your current assets, current liabilities. Once your current assets is less than your current liabilities, then you are in trouble. Yes, a total. Okay. Do you think that that ratio current asset can be too high? Yes. Why? No, forget about trading stock now. And this is why you need to know exactly how to calculate. Debtors could be too high. What else? Too much cash. Why can we make a statement too much cash? If I only need 100,000 per month to keep my business running and operating, not going into any deficit, but I've got R1 million in my current bank account, how can I use that money for better use? Invest it and earn money on that. Okay, so it's something that you also can think of when we look at the current ratio. It's not just too much money is tied up in trading stock. It's not just trading stock that you should focus on only. There could be other things as well. And you'll see it's actually in the question that we are going to complete when it comes to the commenting. Right. If we look at debtors collection and creditors payment, yes, we can compare the debtors collection and creditors payment from last year to this year. We can have a look at our credit term says that debtors has 30 days to pay, but on average they are paying 40 days. So, is that a problem?
Yes.
Why?
Because they're not sticking to cash flow problem.
No, but just why is that credit terms and they're taking longer to pay? Why is that a problem? We're not controlling our debtors well enough. So do we have control procedures in place? Yes. So what can we put in place if there isn't? And if there is in place, why isn't it working? Are we actually checking up, following up? Okay, so these are all things that you can think of and which you can comment on them. But you don't need to write paragraphs and paragraphs and paragraphs. Sometimes you do writing the same things, you're saying the same things in a different way. Okay, and you spend unnecessary time on commenting and you end up not getting finished with a paper. Okay, so keep it simple. Now we don't have last year's figures. What can we do? We can look at how long does it take our debtors to pay us compared to how long it takes us to pay our creditors. Because if we're collecting money later than what we're giving out, can that create a cash flow problem? Yes. So how can we improve our cash flow problem? Is by paying our creditors later. But still make sure you stick within the credit terms. Because if you don't stick with the credit terms, what do you think your supplier is going to do? They're going to charge us interest. It could be that we are paying our creditors within 30 days because settling our account within 30 days means what?
Discount.
We can get discount. But it could mean now that we sacrifice that discount if we're not getting money in quick enough from debtors, if there is a cash flow problem. Okay. Right. Stock holding and stock turnover. How long do we keep our stock? And it could be in months or in days. If your calculations is in months, you need to times it by 12. In days, it will be good. So how long do we keep our stock? And how quickly do we turn that over? Now, why are those two actually joined, linked? Think about it. If I've got a clothing store, how long per year do I keep my stock? Yeah, exactly. There's 4 seasons, so how many months per year will I keep my stock minimum? Okay, so it means how many times a year will I turn over my stock? 4. Okay, yeah. 12 divided by 3 equals 4. So they are kind of joined together, linked. So the quicker I can turn over my stock, the quicker I can sell it, it means I'm keeping it for less. So how do I comment on this now? Because is 20 days good or is it bad? Is 5 times good or is it bad? How do I comment on this?
Comparing it to the...
We can compare it to last year to see if there's an improvement or not. But what else?
Compare it to the stock holding and stock turnover.
No. There's the figures. No, forget about the others. There's the figures. What is the product that I'm selling? If I have cell phones that I'm selling and I have food items that I'm selling, wouldn't it be completely different?
Yeah.
So my commenting will be completely different. So make sure that you familiarize yourself what is the type of product that we are selling. Because if I have cell phones and I have too much stock and I'm not selling them quick enough and we're keeping them for long, those stock can become outdated. Technology changes all the time. Every 2 months there's a new cell phone coming out. So I'm taking that risk that cell phone, nobody will want an old one. They would want the new one. And then I'm not going to be able to sell that. Okay. You can't have pizza, selling pizza, and it's lying in your fridge for a month. That's bad. That needs to be turned over a lot quicker. Okay, so always when you're commenting, what is good, what is bad, what do you compare the figures to? So you can compare it to last year, but also look at what is it that I'm actually selling. That also gives you an indication on how to comment, what to comment on. Now, if there's an improvement on my asset test ratio, wouldn't that also reflect in the stock holding and stock turnover? Yeah. If I'm selling my stock much quicker, wouldn't there be less stock?
On the assets, yeah.
So that's why that two can also join the other one. Okay, so these are all things that you can look at when you're commenting on the liquidity position, and it's a non-negotiable. Grade 11, there's a lot of calculations that you can expect to get at the end of the year, so you must study your financial indicators. This is why I say when you start an exam paper, what do? You go through the answer book. As soon as you start, you write your formats, and you go to this part of the exam paper and you write the financial indicators while it's still fresh in your memory. Write them out next to the question on the answer book. Then it's there. Okay. Any questions on the liquidity? Grade 12, you can expect to get exactly the same. And they will ask you, just comment on the liquidity position. So know how to comment. The best that you can do, when you do your homework on analysis and interpretation, be honest now. Who of you leaves out the commenting part? You just do the calculation. Yeah? Okay, that's the worst thing that you can do. You need to start practicing them while doing your homework. Copying them down, copying down, is not going to help the course in any way. You're never going to practice how to answer it. So please, when you do your homework, make sure that commenting, write something. Don't just leave it open and say, but I've done half of my homework. Because that's why you battle with it in the exam. You don't practice it enough. Okay, then you can see, but how are marks allocated? And the thing about commenting, if you mark it in class and you discuss it, ask your teacher, this is what I've written. Is that correct? Could it be correct? That's how they will guide you in where is it that you're making a possible mistake. Or it could be acceptable as well. Okay. Right, next one. This is liquidity. If we look at solvency, are we solvent? What do we look at?
Our non-current.
Does our total assets exceed our total liabilities? Next, we've got return on investment. And you've done it in grade 10 as well. So in grade 10, you looked at, why do we say return on investment? Because if you start a business, you're actually investing. Okay, so we want to know percentage-wise, what was our return? So what do we look at? We look at the net profit divided by average owner's equity. So average is always beginning plus end divided by 2. But that was now with a sole trader. What makes it now difficult with a partnership?
Each partner has their own beginning and end.
No. Each partner, there's more than one person. So now we have to look at, as a business, what was the return on owner's equity? But we also look at, as a partner, what is your return on your investment? Now, again, I'm going to ask the question, is 15% good or is it bad? Why do you say it's good? See, you have to compare to what? Alternative investments. Can I get something better somewhere else? That's what you based it on. And a lot of times, if you look at the information provided, if they say fixed deposit and they tell you in brackets the interest, why don't you use that as a reference? If it says fixed deposit 10% and now your calculation says 15%, then compare that. Say, my return on my investment is 15% compared to the investment of 12% or 10%. You'll get your marks. Or you can just say 12%, 13%, 20% is good compared to alternative investments. That's how you comment on that. But now, if we look at what is each partner's return on their investment, how would we find out? What do we look at? Okay, all of you go to your current account note. Okay, all got it. Do you think I can get the information from there?
Yes.
Where? Which one? Net profit per income statement. That is their investment, so you have to use that. That is their part of the profit. So how do we get the net profit per income statement?
Salaries and interest. Never mind. Primary distribution plus final.
Correct. Final plus primary. But what does primary consist out of?
Salaries, interest, and bonus.
It's important to know because it all is based on how the information is given to you. This would be an easy way to give the information by telling you exactly what the net profit per income statement is. Otherwise, you will need to calculate it. So it will always be long calculation in brackets because there are a few things that we need to add. Okay, very important. When we look at average owner's equity, what their owner's equity is, current account can have a debit balance, so then it must be minus. Okay, credit plus, if it has a debit balance, it is minus. So their owner's equity would be capital beginning plus end, plus or minus current account beginning and end. But we'll get to that more later on. Does it ring a bell? Mm-hmm. Okay, I hope so, but you haven't done this in a while. So this is why I focus on these sections first to revise all of this work. Okay, very important. So when we look at return financial indicators, we will look at, as a business, what was the return compared to alternative investments, and then we will look at each partner individually, what was their return on their investment. Right, the next one that we look at is the debt equity ratio. What does the debt equity ratio tell us? Who provides the capital? Are we reliant on borrowing money, or is it from the owners, which is the partners in this case? What is our financial risk? Okay, the debt equity ratio is always 2:1. So if our debt D for equity, D for debt, E for equity, whenever, and it's always 2:1, whenever the debt is less than the equity, that's good. Whenever the debt is more, then it means we are high financial risk. Good, if it's lower, it's low, moderate financial risk. Right, now you will see in grade 12, you're also going to do this a lot. We look at our financial risk and we look at if we borrow money. Why do we borrow money? Hopefully not to pay your employees their salaries. Then the business is in a bit of trouble. Yeah? To expand. So what we look at is what was our return on total capital employed. How can I get capital? I can get capital by borrowing money. I can get capital from the partners. Okay, so we look at what was the return on total capital employed, and we look at our financial risk. Right, now what do? If our return on total capital employed is more than the interest at what we need to pay back a loan, that's a good thing. If it's less, it means it's bad. It means that we should rather pay off that loan as quickly as possible because we're not getting a good return on the total capital employed. Because the cost of borrowing money is interest that you pay back. So if I borrow money, I need to make sure that I make a lot of that money so that I can pay off the debt and still make some of that, if that makes sense. Okay, so these are the financial indicators that we look at. Question paper. Hope you've all taken in. No, we still got an hour. Come, you need to practice now. Go to the first question paper. Right. Question 4. Golden Traders is a partnership business owned by partner Young and Son. The financial year ends on 28th February. So now they've given us calculations and we need to comment. Right. What do you need to know? First, how to calculate a ratio, but also how to work out backwards to get an amount. And here's a typical example, the first one. It says calculate the total value of current liabilities. So now instead of asking you to calculate the current ratio or calculate the asset test ratio, now I'm saying to you, you need to calculate the current liabilities. Right, so which one of those 6 would provide me with the answer? Which one of those must I use? The first one, the current ratio. So if I look at current ratio, let me rather write CR for current ratio. How do I calculate the current ratio? It is note number 4 plus 5 plus 6 divided by current assets divided by current liabilities. And that equals, which they've provided you, 2,5 to 1. Now, can I solve, because that's a question mark, can I work out the current assets? Yes, I've got the information there. How do I work it out? What do I need to add? First, what forms part of current assets? So you need to take trading stock plus cash and cash equivalents plus trade debtors. So what is your current assets equal to? Good, 487,000. So now, how do I get the current liabilities? 487,000 divided by 2.5. Good. If I want current liabilities, I need to divide it. If they would have provided me with current liabilities, I then need to times it if I want to work out the current assets. So make sure when you study, don't just always work it out in the normal way. Work backwards as well. See if you can get the answers. Are you fine? Right, so what is the total current liabilities? Good, 194,800, so go fill it in under current liabilities where the question mark is. This is now percentage returned earned by Young, what I spoke about a minute or two ago. Now we look at what was the return on the partner's investment into the partnership. So, remind me again, what is the financial indicator? How do we actually calculate it?
Net profits net profit per year, per income statement over the average owner's equity.
100% correct. So, long calculation. Let's have a look. First, if we look at Young, what do we need to add? How do we get their net profit per income statement? Okay. Are you looking on page 17? You won't find the answer there. The appropriation account says to me the primary and the final distributions of profits. Because remember, it is primary plus final. So what is primary? Salary, interest on capital, bonus. If he got a bonus, make sure you get the correct information with the partner. And then their final distribution of profit. Wait, I will come now.
It's net profit over average
The
partners.
partner's earnings, so don't write net profit because it's net profit per partner. So rather say partner's earnings divided by average owner's equity. It's partner's earnings divided by owner's equity. And it's always the average. It's beginning plus end divided by 2. So how do we get their owner's equity? Now you can go to page 17.
Net profit, you add the current account is
Don't write net profit, say rather partner's earnings. Because it's net profit per income statement for the partner. That's called partner's earnings. So how do we get partner's earnings? Primary plus final. So what does primary consist out of?
salary, interest, and bonus.
Yes.
And then final. you add
And the
current
final. Yeah, because it's primary plus final. It is primary plus final. And to get the primary, it is salary plus bonus plus interest on capital. But just check, we are busy with? Did he get a bonus? Okay. Now, how do we get the average owner's equity?
Capital.
What does owner's equity consist out of? Capital and current account. So it means on page 17, I've got the capital beginning and end, and the current account beginning and end. We are looking at the individual, the partner. No, only one partner. We're looking at their capital contribution, at their current account. So we are busy with Young. So it's Young, beginning plus end. And then the current account, Young, beginning and end. Remember, if current account has a debit balance, what do we need to do? Yes, you need to subtract it. Yes, average is divided by 2. Show all your calculation, look at the mark allocation. If your final answer is wrong, you lose all the marks. So rather write all the calculations. And what are we working out? So you have to have times 100. Percentage is always times 100. Hey?
I think so.
Mm-mm. Well, I think it's just a typo. What is your answer?
45,36.
Good. It's 45,46. 2 decimal places is more than enough. What did you get?
22. Yes, it divided
Oh. Did you first work out the brackets, see if you get the same answers?
I found my mistake.
Oh, do you have your?
Is it necessary to divide capital by 2 and the current account by 2?
No. You can write everything in brackets and then just the whole thing by 2. You don't have to.
Because my teacher said that you mustn't do that.
Let's prove. Let's see. Let's do a test. Did you get the same answer as me?
41.
Hey?
I got 41.
45.46. Ma'am, I got that same first step, but the rounding of decimals. That's 0.46, mine's 0.36.
Mine's also 36.
Yours was 36. I have up to there.
It won't be the same.
That's weird.
Beginning and end. Beginning and end.
Yeah, 45, comma. Oh yeah, see I made it comma 4. I shouldn't have written the 6 there. 1 decimal place. So same. This is yours, this is yours. Yeah. Got the same. Right. Any questions with this? Did you get the same?
No, I got 41.
Because you divided separate.
Yeah. This is how we do.
No, it's fine. Yeah. I guess I just do it this way. Otherwise, you mark it wrong.
I got the same answer as previously when I also divided by 2.
Did you do each one individually?
Okay, maybe it's
So just check your calculations. I will work it out and I will see if there's a big difference or not. Because it's all added in bracket, divided it by 2. I don't see actually why you should get a different answer. Okay. Right, let's have a look. Next one. Make sure that you understand how do we get the partner's earnings.
Partner's earnings is from the appropriation account.
Yeah, what in the appropriation?
Salaries, interest,
Okay, so it's primary plus final. What does primary consist out of? Salary, bonus, and interest. So, do you need to know your theory?
yes.
Okay. Don't ever ask your teacher that question again. Next one. Debt equity. So we said debt equity, we have to look at non-current liabilities divided by the owner's equity. What does owner's equity consist out of in a partnership?
Capital and
Good,
current account.
good. So, but now we don't look at just one partner, we need to look at both. So write all your calculations in brackets. Why? Work out the debt equity ratio.
But the owner's equity is both
Yes,
Both partners.
capital plus current.
of both partners.
Yeah.
And then we just take the one and we take the average.
No, you just add and subtract. When do we subtract?
And there's a debit.
Yes. So in other words, have a look here. I'll answer questions now after I've explained here. If we look at owner's equity consists out of capital plus current account. Now the current account can have a debit or a credit balance. So let's now go and have a look at the capital. But we're not going to look at the average. We are busy with 2000 and... Okay, so go and look at the figures of 2015. It is debt, equity, so in other words, your total non-current liabilities divided by. So what is your capital? It's 525,000 plus 350,000. Now we look at current account. Yes, we have to minus 9,100. Why? Because it has a debit balance. And then we have plus 10,600. So all of that is your equity. What is your total debt equal to? The loan, the non-current, what did you get?
0.23.
I didn't get that.
Yeah, it's right. I forgot to add the current account.
Oh, so it does work out exactly the same. Yeah, it should actually. Yeah, I got the same.
Only for this year.
Yeah, we're busy with 2015.
I added for both.
No. You only take 2015. And we don't work with average in the debt equity ratio. Okay. Right. Asset test ratio. Oh, wait, before we... What was your answer?
0.46.
Okay, or you could say 0.5 to 1. What does that mean? For every... Or forget about even that. What does that mean? Our total equity exceeds our...
Non-current liabilities.
So it means, what is our financial risk?
Low.
Low, it's moderate.
Moderately low.
Yes. Okay. Right, next one. Asset test ratio based on how the information is given. There are two ways that you can calculate it. One would be a higher risk, and the other one is actually no risk. Why? I can say current assets minus inventory. But now what if you by accident calculated your current assets incorrectly there in question number 4.1.1? Okay, so that's why I say, but it shouldn't be. You can add you can take the current assets minus inventory, or you can add what? 5 and 6. Note 5 and 6. Trade and other receivables plus cash and cash equivalents. Both will provide you with exactly the same answer. Now, if you look at the information, they've said to you the trade debtors. They've given to you also the cash and cash equivalents. I can add those two together. Now, the current liabilities, please make sure that you use your answer, which you've calculated in 4.1.1. Those amounts cannot differ, because otherwise if I'm marking, I'm going to check that you use the amount calculated in current liabilities in question 1. If it differs, where did you get that total from? It can't be anything else. Sorry. Okay. So work out the asset test ratio for me. No, man, what did you do? You swapped them around. It's your debt divided by owner's equity. So you swap them around.
And how many decimal places do we round off?
2 or 1.
2 or 2, 1.
Right, what is your answer? 1,6 or 1,59 to 1. What now?
No, she's looking for some formula.
What are you looking for? I can assist.
It's okay.
Putting in other receivables.
Zetas. Yeah, what about it?
Yeah, we put net debtors on top.
Yeah,
In your
format.
thing. Yeah, she was right there.
Let me see.
But in his book, it's like that.
No, but it can be either or, it's fine. Mm.
I was with the wording, I was confused.
Right.
So doctor,
1,59 to 1, or if you round it off to 1 decimal place, your answer is 1,6 to 1. Yes. Yes. No. No. Current assets minus inventory. Okay, so you took.
I bet there's the trade and there's
Correct, that's fine. It should still give you 310,000. I think you added up incorrectly.
300 plus 1.
Did you take 273
Yes, ma'am.
plus 36,800? Oh, okay. Got it. Right. Now comes the fun part, the commenting. Right, let's discuss. Your favorite part. Commenting. Right. Number one, it is important to realize the following. When they say quote, it means you actually need to write the figures down. They say quote two financial indicators with figures in your answer on the liquidity of the business. And this is why it is important to know, what does the liquidity consist out of? What are my options? What is it that I can use? I can either use one of those 6. Okay, but now, please don't use financial indicators where there's no information given. Because how are you going to quote figures? Make sense? Mm-hmm. Even if you've written there, for example, stock turnover rate, but it's correct, it forms part of the liquidity, but there's no information on that, then I cannot comment on it. So make sure that whatever you choose is based on what is given to you. So let's have a look. Do we have the current ratio? Yes, we can comment on that. So now, how do we comment? One, you quote the financial indicator first. You write current ratio. We can discuss this now, then you can do it for me for homework. Okay, let's discuss. So one, you quote the figures, you write the financial indicators. So by quoting figures, you would say the current ratio has improved from 2,5 to 1, from 1,8 to 1 to 2,5 to 1. So I'll start again. You can say the current ratio improved from 1,8 to 1 in 2014. You can even add that to 2,5 to 1 in 2015. By just writing that, you're already getting marks. Right. Now I can quote on another financial indicator. What other options is there? Asset ratio is there. But now you need to make sure you use your calculation. So even if it's completely wrong, just make sure you use that figure. But now is also an important part. Let's say you forgot completely how to calculate asset test ratio. You know that a ratio is always 2. Make sure you write a number there and you use that number. I am being serious. Because how can you quote figures if there's blank spaces? How can you comment on blank things? Does that make sense at all? Okay, so what would you say with the asset test ratio? The asset test ratio was an improvement, yes or no?
Yes.
Why? Because the asset test ratio is 1,2 to 1 in 2014, and it increased to 1,6 to 1 in 2015. Right, now comes the fun part. Analyze that, comment on it, give me an opinion. Hey? No, explain. You've just quoted now and said if there's an improvement. Explain.
The business is liquid because
Come listen.
the business is liquid because our current assets exceed our current liabilities.
100% correct. You can say the business is liquid. Yes, our current, don't write anything. I'm going to tell you lots of things. Our current assets is exceeding our current liabilities. Even if we don't have to sell trading stock, we would still be able to cover our shorts. Okay, but now I quickly want you to go and look at the figures. Because it's clear there's an improvement, but this is what I spoke about earlier. What is a bit of a concern there if you look at the figures? We have a lot of debtors. We need to make sure that we have control over our debtors. Because that ratio actually went up, not because our cash and cash equivalents improved. That ratio went up because look how much our trade debtors increased with. Now, another thing, look at trading stock. We need to be careful with the trading stock as well. The trading stock increased from 50,000 to 177,000. So we need to be careful when we look at the trading stock as well. Use the figures in front of you and just comment on that. You can see the cash and cash equivalents, there was barely any change. So it's clear that the debtors are becoming possibly a problem. It's not to say it is a problem, possibly, because there was a huge increase. Okay, so just be aware, look at the figures, and comment on what is in front of you. Not done yet, there's still a minute. Come, there's still a minute. Let's just finish the last one. That's why I said don't write. Let's just finish quickly. Do you think that Young is satisfied with his return on investment? So what do we compare? First, have a look. What is his investment? What would we look at? Right, we can look at the return on his investment. Young, what was his return on his investment?
48%.
That's good. Yes, it is. There was a decrease, but it's still very good compared to alternative investments. Okay, so that's a very good answer. Yes, there was a decrease, but it's still much better than alternative investment. They said quote 2, so it means the other option that you've got was the return on total capital employed. There was an improvement from 37 to 43%. I wouldn't personally have added return on total capital employed with his return on his investment, but it's the question, and that's the only other financial indicator that I can look at. Got it. Right. Can we make a deal then? 4.4 is homework for tomorrow. It will take you 2 minutes maximum. Come 2 minutes earlier to class. Okay, thank you so much. See you tomorrow. Tomorrow recon and that.